Hello everyone. In this week we are going to study lecture 7 in Managerial Finance. The topic in this week include capital budgeting, the risk analysis, and financial planning. So in your textbook you're going to study chapter 10, chapter 11, and chapter 12. Now we introduce what is capital budgeting. So capital budgeting refers to the process of deciding how to allocate the firm's scarce capital resources, including land, labor, and capital, to its various investment alternatives. So this is a definition of capital budgeting. So the goal of capital budgeting analysis is to determine whether a project is profitable. However, the project cost in today's dollar value, which is the money you have to invest today, while the expected cash flow from the project in the future dollar value. Based on the knowledge we studied from chapter 9, we understand that there is a problem with the measurement and time value of money. Okay, this is the 6 criteria of capital budgeting. Now we're gonna introduce the payback period, the discounted payback period, internal rate of return, modified internal rate of return, net present value, and profitability index. First, what is the payback period? So payback period is the number of years required to cover a project's cost, or how long does it take to get the business money back. The net present value basically is the sum of all the discounted future cash flow. So if the net present value is positive, given that required rate of return, so the project is acceptable. So we can use this equation into 2. So the net present value basically is the sum of the future expected cash flow discounted to the present, and then you have to minus your initial investment. Also here we're showing as cash flow 0. So internal rate of return is just another aspect of calculation. So instead of to solve for net present value, we suppose that the net present value is 0. And given that net present value is 0, and we solve for the internal rate of return. So in this equation, the IRR is unknown, so you have to solve for that. Okay, if the IRR is greater than the required rate of return, so this project is acceptable. The same logic is followed by modified internal rate of return. To calculate the modified internal rate of return, first you need to find the total future value of the cash flows at the reinvestment rate, and then apply the following formula. So the FVCF is the future value of all the cash flow, and divided by the initial investment. The profitability index is the same as the net present value, except that we divide the present value of all future cash flow by the initial outlay. If the PI, or the profitability index, is greater than 1, the project is acceptable. Okay, one thing I need to mention that is you need to understand the project is independent or is mutually exclusive. So what means project is independent? The projects are independent if the cash flow of one are unaffected by the acceptance of the other. If the projects are mutually exclusive, if the cash flow of one can adversely impacted by the acceptance of the other. So this is one of good example in the textbook. You can see the franchise L and franchise S. I provided in another PowerPoint slide in our weekly reading folder. Chapter 11 talk about the risk that are relevant in capital budgeting. So there are 3 types of risk: stand-alone risk, corporate risk, and market risk. Stand-alone risk is the easiest to measure and the more intuitive. Core projects are highly correlated with other assets, so stand-alone risk generally reflects corporate risk. If the project is highly correlated with the economy, stand-alone risk also reflects market risk. To do risk analysis, we have 3 tools: sensitivity analysis, scenario analysis, and simulation analysis. So both the 3 tools are very applicable and you can use in Excel spreadsheet. In Chapter 12, I wanted to introduce a concept in financial planning. It's called AFN, additional fund needed. So when the company grows bigger and bigger, the revenue they generate cannot meet the demand of the fast growth in this company. So the company need more external fund to support the business growth. So how much money they need? Basically, we can use in this AFN equation. Notice that additional fund equation is additional assets minus additional spontaneous liability and minus reinvested profit. Because this is the definitions of variables in the AFN equation. Thanks for listening and have a good week.